Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Contango stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Contango is an oil and natural gas company with properties in the Gulf of Mexico, Texas, Oklahoma, Wyoming, and Louisiana. The company is focused on acquiring crude oil and natural gas properties across the U.S. The company is headquartered in Fort Worth, Texas, and was founded in 1986. It went public in '91 and trades on the New York Stock Exchange and Deutsche Börse. It has been acquiring other companies the past few years, trying to grow its business, expand its asset base, and become more profitable. This chart shows 4 notable deals they've done. They acquired Will Energy in 2019 with debt. They acquired White Star Petroleum. They were in Chapter 11, so they got them at a discount. They merged with Micron Energy in 2020, and then got another Chapter 11 deal with Project Silvertip. These 4 deals will create $100 million of EBITDA and $48 million of cash flow. So it's good to see that they're trying to grow their business, making deals, not just sitting back and letting things get worse. Because they were a lot stronger a few years ago. Their stock price was over $90 at one point. Now it's below $5. The big deal everybody's talking about is the merger with Independence Energy. Independence is a subsidiary of KKR. So Independence and Contango are going to merge in an all-stock deal to create an oil and gas company with an enterprise value of $5.7 billion. To calculate enterprise value, it's market cap plus net debt. Net debt is total debt minus cash. So there's going to be a brand new company created with a new ticker. Independence shareholders will own 76% and Contango investors will own 24% of the combined company. The deal is expected to close in the 3rd or 4th quarter of this year. In 2022, the new company is expected to produce 110,000 barrels of oil equivalent per day. If oil prices continue to rise, this new entity is poised to be a big player in this market. Let's get started with the model. This is a small cap company, 948 million market cap. They're trading at $4.72 a share, and they have 201 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow in 2 of the 4 years. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. Revenue is a sales for the company, and that grows a lot from 77 million up to 138 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and they had their highest gross profit in the trailing 12 months. Below that is operating expenses, and their operating expenses are higher than their gross profit, so they have negative operating income every year. But they did have their best number in the trailing 12 months, negative 10 million. Below that is the interest they pay in their debt, which is about $5 million. Then below that is other income and expenses. These big negatives are asset impairments. An asset impairment is a non-cash item. So you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. So they do have negative net income every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So even though they had negative net income every year, they actually generated positive operating cash flow because there's a lot of non-cash items on the income statement, notably asset impairments and depreciation. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they did have negative free cash flow in 2 years, positive in 2 years. So they're not really using debt to run their business. They paid down more debt than they issued the past 4 years. They're using equity to fund their growth. They issued $33 million in 2018, $125 million in 2019, and $61 million in 2020. Every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable. Let's look at the capital structure. 93 million of equity, 109 million of debt. They're 46% equity, 54% debt. And their WACC, which is a blend of the cost of equity and cost of debt, is 11.18%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 3.1 billion. We discounted those numbers back to today's and the weighted average cost of capital. We get a value of the company of $2.3 billion. We divide that by 201 million shares. And we get a calculated stock price of $11.63. They're trading at $4.72, so they're trading at a 59% discount. It's a strong buy according to the model. But I valued the company based off of the merger with Independence. If the merger doesn't go through, then this valuation will be a lot lower. Plus, Contango is going to get 25% of the new company. So if you think about it, 25% of 1163 is lower than 472. So it may take time for you to make money on this investment. Of course, if oil prices go way up, then you're going to make a lot of money a lot faster. But if oil prices go up a little bit, or even go down, the stock may struggle. One analyst priced this stock and their price target was $5. This is the stock price since it started trading. So you can see the stock was way up there, almost $90 a share back in 2006. But it really struggled since then, below $5. So it's trading at a major discount relative to its all-time high. So it looks like the stock has gone up the past year. This is the point where they announced a merger with Independence. So the stock shot up. It has come down, but it's still trading a little higher than it was before the merger announcement. This is a pretty volatile stock. It has a beta of 2.35, so the stock moves more than 2 times the market. The stock is similar to the S&P 500. It's up 32%. The S&P 500 is up 34%. The 52-week low was 109 and the high was $7. The stock is trading above its 50-day and 200-day moving average. About 1 to 2 million shares are traded each day on this stock. Of the 201 million shares outstanding, 124 million are on float. The 77 million shares not on float are held by insiders, so they can't be purchased by people like me and you. 23% of the shares are held by institutions, and over 4% of the shares on float are shorted. This stock has really struggled the past 3 years and 5 years, down a lot. But in the past year, it's up 32%, which is less than its industry and the market. In the past 5 years, their earnings have struggled, down 5% on average each year, while its industry is up 4% and the market is up 12%. But in the past year, their earnings increased 75%. But their earnings went from a big negative last year to a small negative this year. The earnings in their industry went down 43% in the past year. It's mainly because oil prices have really struggled the past year, while the market is up 21%. If you invested $10,000 into this company 10 years ago, you'd have $840 today. That's a 92% loss. So if you're looking for a stock that's trading at rock bottom prices, this could be it. You could make a ton of money with this stock, but it is risky. But the greater risk yields the greatest rewards. It's not like investing in a company like Microsoft or Google, because if there's a big market crash and the entire market goes down 50%, and a stock like Apple goes down 50%, you're getting Apple at a great discount because you know Apple's a great company and the stock price will go up. This company is a bit risky. It's trading at a really big discount. There's no guarantee it will go up. I think there's a good chance it will go up, but it's not a solid, secure company like a blue chip stock. The chairman of the board of this company and the new entity is John Goff. He's a really shrewd billionaire investor, and he's trying to make a lot of deals with different companies to try to grow the business. So he knows what he's doing with his money. So if he's successful and you invest in this company, you can make money with him. He owns 17% of the stock and his company owns 6.6% of the stock. That's why it has a low float percentage, because of John Goff. He owns so many shares. Avondale Growth owns 5%, then Carlin Investment, then DWS Growth. Let's look at their financial ratios. They have negative net income, so we can't look at the PE. The average price of sales in the market is 9.2, the median is 2.8. Price of sales is stock price over sales per share. And the way you calculate sales per share, it's revenue over shares outstanding. They're at 6.9, so that means investors are paying about $7 for $1 revenue. That's between the market median and average. Their price to book is 10.2. That's a little worse than a market average. They have negative operating income, so they have negative return on invested capital, negative interest coverage ratio, and negative ROE. They can cover only 50% of their current liabilities with their current assets, and their current assets are mainly receivables of $54 million. Receivables are when others owe you money. Payables is when you owe other people money. Accounts receivable is an asset because people owe you money, but it's not as good as cash. Because when you have a receivable, you have to wait for the cash, and sometimes you don't get the cash because the other company goes bankrupt. They seem to be undercapitalized. They had negative free cash flow and they have negative working capital. So they have negative $126 million of funding. So they may need some debt or equity to run their business over the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 15 companies in the same industry as MCF, and MCF is worse in every category when compared to the average in the industry. So obviously this company is really struggling. Their stock price is really low and they have terrible ratios. So that's why they're trying to make a lot of moves to grow their business. So to summarize, I have them trading at a 59% discount. This merger with Independence will really be a game changer for this company. When you invest in a company that's struggling, you want to see them do things and make moves, not just sit back and let their company fizzle out. Plus they have John Goff, who's a really great leader, who's going to really help them grow and be successful. So it's not just putting your money into this company, it's putting your money into him. He's obviously made a lot of money in his lifetime. He's really familiar with this market. He's invested in a lot of companies. So I'm really excited to see how this merger develops and the future moves this company makes in acquiring other businesses. Because it's really hard to grow as an oil and gas company. There's only a finite number of locations you can pull oil and gas. It's not like you're selling products and you could just come out with a new product or come out with a newer version of an old product. There's only a certain number of places you can pull oil and gas from, so you have to acquire others to grow or merge with them. So this new merger has a lot of their investors really excited. I ranked their free cash flows 1 out of 10, their revenue 6 out of 10, and their ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.